Today we're going to dig into a really fascinating company, Gujarat Themis Biosyn. And it brings up a classic puzzle for any investor. What do you do when you find an absolutely incredible company that everyone else has already discovered? Can a business be so good that its stock price becomes, well, kind of imperfect?
So let's just jump right in with a number that pops off the screen, 43%. Now what is that? That is Gujarat Themis's operating margin. To give you some context, the average for the whole pharmaceutical industry is somewhere around 20, maybe 25%. So yeah, this isn't just good, it's truly exceptional. It's our first big clue that we're looking at something really special here.
So how on earth do they pull off numbers like that? Well, that takes us right into our first section. We need to understand what makes this company such a powerhouse in its own little corner of the market.
Okay, so at its heart, Gujarat Themis makes the key, active stuff that goes into drugs, the APIs. And they do it using this super complex process called fermentation. But here's the really cool part of their story. They were the very first company in India to commercially produce Rifampicin, which is a critical drug for fighting tuberculosis. This wasn't just some random product launch. It basically cemented their dominant spot in the market right from the start.
And that early lead helped them build what investors love to talk about, a competitive moat. It's like the defenses around a castle that keep competitors out. And their moat is seriously deep. They have a near monopoly on their main product, expertise that is just incredibly difficult to copy, and huge regulatory hurdles that stop new players from even trying. You throw in their long-term customer deals and a key tech partnership with Korea's Yuhan Corp, and you've got a business that is just incredibly well protected.
All right, so we have this dominant business. Now let's see how that translates into the financials, because this is where the story gets really, really compelling. The numbers don't just back it up, they shout it from the rooftops.
And here we are, back to that number we started with. Seeing it side by side like this just drives the point home, doesn't it? Their ability to turn sales into actual profit is nearly double the industry average. That's a massive signal of their pricing power and just how efficient they are. They're not just playing the same game as everyone else, they're on a totally different field.
And this isn't some recent hot streak. Just look at this performance over a whole decade. Revenue growing at 17% a year and profits growing even faster at 26% every single year. And those return numbers, ROE and ROCE, they're just incredibly strong. It shows that management is fantastic at taking money and turning it into even more money.
So it all adds up to a company that is just in pristine financial health. But the real star of the show here, the absolute highlight, is the balance sheet. They are virtually debt-free. In a world that's always a little uncertain, having no debt is like a superpower. It gives them so much flexibility and resilience. It's a huge, huge advantage.
So a debt-free, super profitable, dominant company that's growing like a weed, it sounds absolutely perfect, right? But this is where our story takes a little twist, because a perfect company doesn't always equal a perfect investment. We've got to look at the other side of the coin. And that leads us to section 3, because let's be real, no company is completely flawed. And the analysis we're looking at flags a few really important risks that are kind of hiding behind those amazing headline numbers.
Yeah, this is where things get a bit more complicated. So, despite all those profits, it takes the company a really long time to collect the cash from its sales. We're talking 185 days on average. The whole cycle, from start to finish, takes an incredible 320 days. That ties up a ton of cash. The analysis also points out that their reports aren't super detailed, and they are really dependent on that one big drug, Rifampicin.
And then, beyond the financial nitty-gritty, there are some questions about governance. The ownership structure is pretty complex, with a few different corporate players involved. When you combine that with the limited transparency and some potential deals with related companies, it just adds a layer of uncertainty for investors who really like things to be straightforward. Okay, so we have an amazing business, but it's got some quirks and risks. But honestly, the biggest risk of all might just be the one we're going to look at next, the price. The price you have to pay to get a piece of this action.
And wow, this chart really says it all, doesn't it? The price-to-earnings ratio, basically how much you're paying for each dollar of profit, is at a sky-high 96.5. Its competitors, they're trading for less than half of that. The market knows this is a fantastic company, and boy, has it priced it for absolute perfection, leaving zero room for anything to go wrong. So what analysts do is they try to figure out a fair value for the stock by looking at its future potential. And even in their most likely scenario,
what they call the base case. They think the fair value is somewhere between 325 and 350 rupees a share. But the stock is currently trading around 396 rupees. So the analysis is pretty clear. It suggests the stock has already gotten way ahead of itself.
So, you've got a top-tier business trading at a top-tier price. How does the analyst from our source material put all of this together and give us a final verdict? What's the call?
And the final recommendation is a hold. Now, this is important. It's not a sell because you don't just get rid of a company this good, but it is definitely not a buy either because at this price, there's just no margin of safety. It's basically a recommendation to be patient and wait for a better entry point.
This quote from the analysis just sums up the whole dilemma perfectly, doesn't it? It says, yes, this is a high-quality business with a great moat, but the price tag right now looks pretty stretched. This is the core problem we've been circling this whole time. So what's the game plan? What's the actionable advice here? Well, the analysis lays out a really clear strategy. If you're already on the stock, the advice is to hold on to it. If you're new and want in, be patient. Wait for the price to maybe cool off and come back down to that 320 to 340 rupee range. That seems to be the sweet spot.
And that leaves us with the big, universal question that every single one of us has to wrestle with as investors. It's not just about this company, it's about any great company. Quality is worth paying for sure. But at what point does the price just get too high? How much is too much to pay for a fantastic business? That's definitely something to think about. Thanks for joining us.